We need to start today by looking at the screens. Because if you've opened your portfolio app in the last, say, 48 hours, you probably just wanted to close it immediately.
Oh, absolutely. It's one of those days.
It is February 5th, 2026, and the board is just flashing that specific shade of red that, makes your stomach turn. We have breached 65,000.
Which was the big one. That was the psychological line in the sand. I mean, that was the floor. Everyone was watching.
It's the line everyone said wouldn't break, and yet here we are. We're down nearly 50% from the highs of October 2025, where we were sitting pretty at, $126,000?
It feels like a lifetime ago, doesn't it?
It really does. And naturally, I'm seeing the headlines. The Bitcoin is dead. Articles are being copy-pasted from 2018 and 2022 and virtually every other cycle. It's almost a tradition at this point.
It really is. The obituary count must be in the high hundreds by now.
But we aren't here to do a mournful postmortem. We have a stack of research here. We've got technical papers, energy market data, a ton of on-chain analytics that suggests something else is happening under the hood.
It is, and I have to say, it's probably the most counterintuitive data set I've seen in a long time.
Yeah.
The price is screaming disaster, but the actual network data is screaming evolution.
Evolution.
And I know that's a hard thing to hear when you're looking at your balance, but the sources we've got are quite specific about this divergence.
And that's the disconnect we need to explore, because you're arguing, based on this material, that this crash isn't a failure of the protocol. You're calling it, what was the term from the source? An educational mechanism.
It sounds cold. I know. It sounds a bit detached when people are losing real money. But yes, the thesis here is that Bitcoin's primary goal isn't, number go up in a perfect straight line.
Right.
It isn't a rapid total victory where it replaces the dollar overnight. The real goal, the only goal that matters, is sustained survival.
Sustained survival.
And paradoxically, these crashes, this pain we're feeling right now, are described in these papers as the necessary stress tests that actually prove the system works.
Okay, stress test is one thing. Watching half your net worth evaporate on paper is something else entirely. But I want to give this a fair hearing, because the alternative is just panic selling.
Which is usually the wrong move.
Usually. So we have a roadmap today that covers a lot of ground. We're going to look at the identity crisis Bitcoin is facing. Why on earth is it trading like a tech stock? We're going to unpack the Lindy effect, which is a term I keep hearing, but I'm not sure everyone fully grasps.
It's a fascinating concept.
Then we'll get into the Joule Paradox regarding energy, which is a huge topic. And finally, the horizontal spread happening between the whales and, well, the rest of us.
Welcome to the Deep Dive. I'm Satoshi.
And I'm Satoshi. So let's start with the immediate context. Let's do the anatomy of the drawdown, as the analysts are calling it. It feels like we just walked off a cliff. What pushed us?
It really wasn't one single shove. It was more like a cascade, a series of dominoes.
Yeah.
You have to look at the setup. The market was already, jittery. We had been bleeding slowly since those October highs.
It was a slow bleed for months, yeah.
But the real catalyst, the match in the powder keg, was the geopolitical news that dropped on February 1st.
You mean the Liberation Day tariffs?
Correct. President Trump announcing these sweeping tariffs on European nations.
Oh.
Now, look. Regardless of your political stance on tariffs, the market absolutely hates uncertainty.
It's the one thing it can't price in.
Exactly. And in the algorithmic trading world, tariffs just equals global slowdown. It equals sell risk. So the bots they turned on. The sell programs lit up.
And just when that was happening, we had the monetary policy kicker.
Yes. The 1-2 punch. The nomination of Kevin Warsh as the next Federal Reserve Chair.
And for anyone who doesn't follow Fed watchers, Warsh is known as a hawk.
A major hawk. He's historically very, very cautious about rate cuts. So the market had been pricing in a future of easy money, more liquidity injections, maybe some cuts later in the year. And suddenly, with Warsh in the picture, that future liquidity looks a lot more restricted.
So you have a trade war looming and a Fed chair who probably isn't going to turn on the money printer to save us. It's a double whammy for any risk asset.
A perfect storm.
But here is the thing that confuses me, and I'm sure it confuses a lot of our listeners. Bitcoin is supposed to be the hedge, right? It's our digital gold. If the whole system is getting shaky, if there's trade war talk, shouldn't people be flocking to Bitcoin? Why is it crashing with the stock market?
And this is the core of it. This brings us right to what the sources are calling Bitcoin's identity crisis. And to understand this, we have to stop looking at the philosophy of Bitcoin and start looking at who is actually trading it right now.
It's not just the cyberpunks anymore.
Far, far from it. It's Wall Street. It's institutional algorithms. We have to realize that over the last few years, the big quantitative funds, the big hedge funds, they've built massive automated trading desks.
Right.
And these robots, these complex algorithms, they do not understand philosophy. They don't read the Satoshi white paper. They operate on one simple thing: correlation buckets.
Correlation buckets. So they lump assets together that move in similar ways.
That's it exactly. To these giant risk parity models, Bitcoin is not freedom money. It is a high beta technology asset. That's the bucket it sits in. It's in the same category as high growth tech stocks, AI startups, and speculative biotech.
And beta just measures volatility relative to the broader market, right? High beta means it moves more.
Correct. Historically, when the Nasdaq drops 1%, Bitcoin might drop 3%. That's high beta. So when the tariff news hit, the risk models didn't sit there and analyze the nuance of sovereign debt. They just calculated global risk is up, volatility is rising, dump the highest beta assets first to protect capital.
So it's completely indiscriminate. It's just an if this, then that command. The robot sees risk up, so it sells the thing that moves the most.
Precisely. And this is what creates the reflexivity trap that's mentioned in the source material. It's a vicious cycle.
How does that work?
Well, the algorithms sell because they see Bitcoin as correlated to tech. The price drops. But because the price drops at the same time as tech stocks, the statistical correlation between them actually tightens. It gets stronger.
Which tells the algorithms they were right to sell in the first place.
It's a perfect self-reinforcing feedback loop. As of right now, February 2026, the 30-day correlation with the Nasdaq is at 0.68. The volatility correlation is 0.88. I mean, that is the highest in history.
Wow.
Bitcoin is temporarily decoupled from its own fundamentals, hash rate, adoption, all of it, and is completely trapped in the logic of traditional finance.
That has to be incredibly frustrating for the sound money crowd. You buy it to opt out of the system, but the price is being dictated by robots that treat it like it is the system.
It is deeply frustrating, but the sources argue pretty convincingly that it's also temporary. This is a phase. This identity crisis resolves when the asset matures enough or when the narrative shifts so strongly that the quants have to rewrite their algorithms. But for right now, today, we are in the trap.
Okay, so we're stuck in this loop where robots dump Bitcoin every time the Nasdaq sneezes. That's the bad news. But the thesis of this whole deep dive is that this isn't the end. You mentioned earlier this idea of survival as success. Can we pivot to that? Because I have to be honest, survival feels like a pretty low bar when we were just dreaming of 200,000.
It feels like a low bar, but historically, and even philosophically, it's actually the highest bar there is. This is where we need to unpack the Lindy effect.
Ah, yes. I see this term thrown around on Twitter constantly, usually by people trying to make themselves feel better about losing money. Tell me, is there actual math behind this, or is it just a fancy coping mechanism?
It is definitely not just coping, although it certainly helps on days like today. The concept itself comes from this story about Lindy's Delicatessen in New York, where comedians used to gather.
Okay.
And they noticed that the comedians who'd been working for, say, 10 years were likely to keep working for another 10. The new guys were the ones who flamed out. But it was Nassim Taleb who really formalized it in his book Antifragile.
Right.
The best way to think about it is to distinguish between the organic and the informational.
Okay, break that down for me.
You and I, we're organic. Every day we live, our total life expectancy actually decreases. We're running down a clock, we accumulate damage. We are, in a word, fragile.
Thanks for the cheerful reminder.
Sorry to be so morbid. But technology's ideas, books, protocols like Bitcoin, they're different. They're informational. They don't have a biological lifespan. Their mortality rate is highest at birth.
So most startups fail in year one. Most new crypto projects fail in month one.
Exactly. They are extremely fragile in the beginning. That's the filter. So if a book has been in print for 50 years, the probability that it will be in print for another 50 years is actually very high because it has already survived the relevance filter. It's proven it has some utility.
And Bitcoin is, what, 17 years old now?
17 years old. And in that time, it has survived a ban by China, a global superpower. It has survived the complete collapse of FTX and the banking crisis of 2023. It survived massive Fed rate hikes.
And now it has to survive a global trade war and a hostile Fed share.
Exactly. And if it does, if it's still here in a year, the market, consciously or not, updates its probability of future death to be lower. Every day doesn't die, it gets stronger.
That's why the sources compare Bitcoin's Lindy score to the Federal Reserve and BNY Mellon, right?
Yes, and it's a shocking comparison. The Federal Reserve was created in 1913, so it's about 113 years old. BNY Mellon is much older, about 18 times the age of Bitcoin. But here's the catch a lot of people miss: fiat currencies themselves. Historically, unbacked fiat currencies, which is what every currency is today, have an average lifespan of about 27 years before they either fail or are hyperinflated away.
27 years, wow. So the dollar system as we know it, the floating exchange rate system that started in 1971 when Nixon closed the gold window, isn't actually ancient.
Not at all. It's a middle-aged experiment. And Bitcoin is closing that Lindy gap. In that sense, it's aging in reverse. Every day it doesn't die, it gets younger and stronger relative to the slowly decaying fiat system.
That is a wild way to think about it, but let's connect this to the concept of antifragility.
Yeah.
You mentioned Taleb. He says Bitcoin needs stress. Most things I own tend to break under stress.
And that's the key difference between robust and antifragile. If you drop a plastic cup, it doesn't break. It's robust. It just stays the same. But if you have something that actually gets stronger when you drop it, that is antifragile.
So how does Bitcoin get stronger from a price crash? I mean, a crash feels like it weakens the network, miners turn off, people get scared and sell.
Well, first, it flushes out all the dangerous leverage. That's the algorithmic trading we were just talking about. It wipes out the gamblers who were just betting on price.
Okay, the system deleverages.
Then, it distributes coins from weak hands, people who panic, to strong hands, people who believe in the long-term thesis. It forces miners to become more efficient to survive the lower profit margins. And crucially, it triggers developers to work even harder on security because the stakes suddenly feel much higher.
So the network essentially learns from the attack. A stable, unchanging system never learns anything. A volatile system is constantly learning and adapting.
That is the argument. The volatility, the very thing we all hate, is actually the learning mechanism. It's the tuition fee we all pay for a stronger network.
And the obituaries we're reading today.
They are the stress tests. And in a low-trust society, which, let's be honest, 2026 is definitely shaping up to be, the value of trust is at an absolute premium. The source makes this point that Bitcoin becomes cheaper to produce than the societal cost of trying to trust traditional institutions that keep changing the rules on you.
That is a really powerful perspective. It shifts the view from, oh no, we lost 40% of the price, to, okay, we just survived a massive coordinated stress test.
It's a complete reframing.
But I want to connect this to adoption, because usually when the price goes down, general interest goes down, people tune out. The sources mention something about a pedagogical shift, a shift in how we learn about Bitcoin. What does that mean?
This is critical for the long-term view. Think about how most people get into Bitcoin. Why did you first look at it?
Honestly, probably because I was worried about inflation, or I saw the government printing trillions of dollars during the pandemic and thought, this can't possibly last. Or, because I saw a green candle on a chart and got a bad case of FOMO.
Exactly. It's a mix of speculation and what one of these papers calls negative marketing. You are sold on Bitcoin based on the failures of other systems.
Right. Fiat is bad, inflation is theft, the banks are corrupt.
It's an effective sales pitch, but it has a built-in limit. It relies on anger and fear to work.
And if the fear goes away, what if inflation cools down for a few years?
Then the sales pitch completely falls apart. People say, why do I need Bitcoin? The dollar seems fine today. If your entire identity is anti-dollar, you are fundamentally dependent on the dollar failing for your own success.
Which is a weak position to be in.
A very weak position. The sources argue that for Bitcoin to really win, to survive the next decade, it has to shift from that to positive utility.
So not just the dollar sucks, but here's what Bitcoin is actually useful for.
Precisely. And crashes are the only time this real education happens. When the price is skyrocketing, nobody cares about the text, they just care about the gains. But when the price crashes, the speculators run for the hills. The only people left are the ones willing to ask, okay, what did I actually buy? Does this thing do anything besides fluctuate wildly?
And this is where the technology acceptance model comes in, the TAM. That sounds like something out of a business school textbook.
It is, but it's a useful framework for how people adopt new technology. It all boils down to two things: perceived ease of use and perceived usefulness. The crash buys the network time to teach the survivors about its usefulness.
The ones who stuck around.
Yes, and the sources highlight three main pillars of utility that go way beyond just price goes up.
Okay, lay them out for me. What are the three pillars?
The first is global energy arbitrage, which is a game changer. The second is the big bounty, the verifiable security. And the third is the sovereign ledger, the simple fact of having a database with no central authority.
Let's jump straight into that first one, energy. Because this is usually where the critics come out swinging. It boils the oceans, it wastes more electricity than a small country. But your notes here mention something called the Joule Paradox. That sounds like a sci-fi movie
It
title.
does, doesn't it? But it's a very real economic concept that turns the whole energy debate on its head. The Joule Paradox states, energy sets the value of Bitcoin, and Bitcoin sets the value of energy.
Okay, that's a loop. Unpack that for me.
Let's start with the first part. The value of Bitcoin is anchored to the cost of the energy required to create it. That's its proof of work. But the second part is where it gets really interesting.
I want to challenge this energy narrative a bit, because to the average person, using energy is bad. We're all trying to save energy, reduce our carbon footprint. Why is Bitcoin eating electricity a feature and not a bug?
That's the right question to ask. And to understand it, you have to understand the physical limitations of energy itself. Electrons are, for all practical purposes, heavy.
You mean in a physics sense?
In an infrastructure sense, it is incredibly expensive and inefficient to move electricity over long distances. So if you build a massive solar farm in the middle of a desert where the sun is perfect but there are no cities for hundreds of miles, you have a huge problem.
You can't get the power to the people who need it.
Right. You lose a huge percentage of that power just trying to send it through the wires. It's called line loss. That energy is effectively trapped where it's made. It's stranded.
And stranded energy has a market value of what? Zero?
Zero. Or even negative, because sometimes the grid operator has to pay you to stop producing so you don't overload the system. This is the great inefficiency of the green energy transition. We can generate the power, but it's often in the wrong place at the wrong time.
Okay, so we have all this wasted energy, and Bitcoin fixes this. How?
Bitcoin breaks the physical constraint of geography. It is location agnostic. You don't need to build a billion-dollar transmission line to move the electricity. You move the miners to the electricity.
You bring the customer directly to the source.
Bingo. You can drop a shipping container full of ASICs, those are the specialized mining computers, right next to that solar farm in the desert. You then convert those otherwise useless stranded electrons into digital blocks on the Bitcoin network.
And unlike electricity, Bitcoin has no transmission loss.
Zero. You can send $1 billion of Bitcoin value from that desert to an office in New York instantly for a few bucks. You're essentially teleporting the value of the energy without having to build the physical power lines.
So it's not just a consumer of energy, it's acting as a digital energy reservoir.
That's a great term for it, or a digital adapter. It makes renewable energy projects bankable. Think about a wind farm. The wind often blows strongest at night when nobody is running their air conditioning. Normally, the operator has to curtail the turbines, just turn them off, they lose money.
Which makes investors really hesitant to fund new wind farms in the first place.
Exactly. But if you have Bitcoin miners plugged into that wind farm, they become the buyer of last resort. They are programmed to automatically buy every single kilowatt the grid doesn't need, 2047. The wind farm stays profitable around the clock. In effect, Bitcoin subsidizes the green energy grid.
That is the positive utility argument right there. It's not just using energy, it's balancing the grid and making renewables profitable. But what about the waste monetization? The sources mention flared gas from oil fields.
This is huge, and it's happening right now. When oil companies drill for oil, they often hit pockets of natural gas. If there's no pipeline nearby to capture it, they just burn it off into the atmosphere, they flare it.
Which is just a massive environmental waste.
It's literally burning money and polluting the planet at the same time. It releases methane and CO2, and they get $0 for it. So now, Bitcoin miners are parking mobile data centers right next to these flares. They capture the gas, run it through a generator to create electricity, and use that electricity to mine Bitcoin.
So they stop the methane emission because burning it in a generator is much cleaner than just flaring it. And they turn a total waste product into a valuable asset.
It turns an environmental liability into a profitable asset.
It seems so obvious when you lay it out like that. Why isn't this happening everywhere?
It is starting to, in places like Texas and the Middle East. But it takes time and capital to build out the infrastructure. And this brings us right back to our crash. The network has a floor price, and that price is determined by the cost of energy.
The cost of production.
Yes. In late 2024, the data shows it cost about 800,000 kilowatt hours to produce one single Bitcoin. At average industrial electricity rates, that put the production cost somewhere between $55,000 and $65,000.
Wait, so if the price drops to 65,000, where we are today, we are right at the cost of production for a lot of miners.
We are hitting the pain point, and this is why the price crash is actually a mechanism for efficiency. If the price drops below your cost to mine, the inefficient miners, the ones using expensive, often dirty energy from the main grid, they go bankrupt. They have to turn off their machines.
It's survival of the fittest on a global scale.
Exactly. And who survives? The miners who are using stranded geothermal energy in Iceland, or cheap hydro in Quebec, or that flared gas in Texas, they have the cheapest power, often close to zero marginal cost. So the crash literally forces the network to become greener and more efficient over time. It cleans out the system.
That is fascinating. So the price drop basically evicts the wasteful miners from the network. It's an economic immune system.
That's a perfect way to put it.
Okay, so that's the energy pillar, which is a really strong counter-narrative. Let's talk about the second pillar, security. The big bounty. I love this concept because, again, in a crash, people worry, what if it gets hacked? What if there's a secret backdoor?
The question of how do we know it's actually secure is a completely valid one. And the best answer isn't just trust us. The answer is the bounty.
And this is referring to the Satoshi coins, right? The very first coins ever mined.
It starts there. We know from the public ledger that Satoshi Nakamoto, the creator of Bitcoin, mined about 1 million Bitcoin in the very early days. And those coins, the Genesis coins, have sat in those wallet addresses for over 15 years. They haven't moved an inch.
And at today's prices, even at a depressed $65,000, that is $65 billion.
Correct.
Okay.
$65 billion just sitting there, completely exposed on the public blockchain for anyone to see. This is the unbreakable bounty. It is a giant pot of gold sitting on the sidewalk at the internet with a sign that says, "Take me if you can."
And if the encryption could be broken, if the math was flawed, if there was some hidden backdoor,
Someone would have taken it by now, absolutely. Hackers are economically rational. Even if you're a state actor with a massive budget, $65 billion is a lot of funding for your Black Ops program. The fact that those coins are still there is the most powerful, empirical, real-world proof that the math works. It's not theoretical security. It's proven economic security.
but the sources do mention a looming threat. We can't talk about security in the 2020s without talking about quantum computing. This is the end boss for all of cryptography, isn't it?
It is the elephant in the technical room, for sure.
Yeah.
And there was a paper in May of 2025 from some Google researchers that sent a real shockwave through the cryptography world.
What'd you say?
They found that future quantum computers might need 20 times fewer qubits, the basic unit of quantum information, than we previously thought to break RSA encryption.
That sounds bad.
It is concerning. Now, to be precise, Bitcoin doesn't use RSA directly for its wallet keys. It uses something called ECDSA, elliptic curve digital signature algorithm. But the underlying math is related. The fear is that if quantum computers get powerful enough, fast enough, they could theoretically derive your private key just by looking at your public key.
So if that happens, the game is over. All the coins get stolen instantly.
Not necessarily. And this is where the whole survival thesis comes back in. The network is not static. It's aware of this threat. There are already Bitcoin improvement proposals, BIPs, being worked on right now to introduce quantum-resistant signatures into the code.
It's an arms race.
A constant arms race. But here's the catch. To upgrade the network protocol, you need consensus. You need the global community of miners, developers, and users to agree.
And we all know how much the Bitcoin community loves to argue about every little change.
True. But an existential threat like this tends to focus the mind. If the choice is upgrade the code or lose all your money, consensus tends to happen pretty quickly.
So what would that actually look like for a user? A hard fork.
Most likely, it would be a soft fork that introduces a new quantum-safe address type. You, as a user, would have to consciously move your Bitcoin from your old vulnerable address to a new quantum-safe address.
A forced migration.
Exactly. The network would basically say, you have 1 year to move your coins, or they might be at risk. It would be messy. It would be scary. The price would probably crash again during the transition because markets hate that kind of uncertainty. But if it survives that,
That is the ultimate Lindy test.
it's the final boss. If Bitcoin survives the quantum transition, it basically becomes immortal from a technical standpoint.
That is a terrifying but also hopeful thought. But before we get to sci-fi quantum hacking, the sources mention something way more common and, frankly, more tragic: user error. They talk about the Kudelski study.
This is tragic, honestly, because it was so preventable. Researchers at Kudelski Security looked at hundreds of wallets that were hacked and drained. They managed to break into 764 of them.
Mm.
But they didn't break Bitcoin's math. They broke the randomness.
The randomness, what do you mean?
When you create a new Bitcoin wallet, your computer or your phone has to generate a very, very large random number. That number becomes your private key. If that number isn't truly random, if the software you're using uses a weak pseudo-random number generator, it can create a subtle pattern.
So if the software is lazy or poorly designed, the key becomes predictable.
Exactly. The researchers found they could predict the private keys for these 764 wallets because the software used to create them was flawed.
So the vault door is made of impenetrable titanium, but the users were accidentally leaving the key under the doormat.
That is the perfect analogy. The key takeaway here is that the core protocol is solid. The wrapper, the wallets, the app, the users themselves, that is almost always the weak point. And that brings us right back to education. Survival relies on people learning how to actually use these powerful tools properly.
Which is a perfect segue to who is actually using the tools right now. We've talked about the crash, the energy, the security, but who's buying and who is selling in this downturn? Because you mentioned a horizontal spread, to me that sounds like a delicious dip, but I assume we're talking about the distribution of coins.
We are. And this is, when you dig into it, perhaps the most bullish long-term data point in this entire stack of research, despite all the red candles on the chart. We are witnessing a massive, silent wealth transfer.
Okay, break it down for me. Who is selling?
The whales. Specifically, the on-chain data tracks wallets holding between 1,000 and 10,000 Bitcoin. This cohort has been consistently selling since the peak back in October 2025. They held about 3.2 million BTC at the top, and they have dumped about 200,000 of those coins onto the market.
That is a massive amount of selling pressure. I mean, that alone explains a big part of the price drop right there.
It is. They were de-risking. They saw the tariff talk coming. They saw the macro headwinds from a hawkish Fed, and they took profits. Classic smart money behavior.
Okay, so the big smart money is getting out. On the surface, that sounds really bad.
It would in the stock market. But now look at who is buying what they're selling. As the price crashed below $80,000 in early 2026, the cohort of wallets holding less than one Bitcoin, the plebs, the shrimps, the retail investors, that group increased their net inflows by 4%.
So the little guys are buying the dip while the hedge funds are selling. I mean, usually in the stock market, that's called dumb money holding the bag. Why is this different for Bitcoin?
Because in a decentralized network, concentration of ownership is a vulnerability. It's an attack vector. In the stock market, you want concentration. You want Warren Buffett holding a huge chunk of your stock because he stabilizes the company and influences the board in a positive way.
Right. But for a network.
For a network, that's a liability. Think about it. If BlackRock and 3 other massive hedge funds own 80% of all Bitcoin, and the U.S. government decides they want to kill Bitcoin, what do?
They just subpoena 4 CEOs. They pressure them in a closed-door meeting.
Exactly. It's a cheap and easy attack. They just choke the few choke points. But if that same amount of Bitcoin is distributed among 30 million regular people living in 12 different countries,
you can't subpoena 30 million people. It's impossible.
It becomes physically, logistically impossible to ban or control. This is why the plebs buying the dip is actually a fundamental security upgrade for the network. The Gini coefficient, which is a measure of wealth inequality, is actually improving during this crash. The coins are dispersing from the few to the many.
So the price pane is the very mechanism that decentralizes ownership of the network. If the price only ever went up in a straight line, the early whales would never sell, and the network would stay dangerously centralized.
Correct. The crash is the redistribution mechanism. It's painful, but it's absolutely necessary for the long-term sovereign quality of the ledger.
And the sources mention the HODL wave data supports this theory.
It does, beautifully. The ODL wave chart tracks how long coins have been sitting still in a wallet without moving. And the data shows that the percentage of coins that haven't moved for 7 to 10 years is actually increasing right now during the crash.
So these are the true believers.
This is deep dormancy. It means there is a bedrock of holders who didn't sell at 126,000, and they sure as hell aren't selling at 65,000. They are the immovable floor.
They are the concrete foundation the market is built on.
Okay, so we've established the network is getting more energy efficient, it's getting more distributed among the people, and the diehards aren't leaving. But we still like to look at the future. We're in early 2026. What do the next 10 years look like? The sources talk about 2035 and this idea of a strategic reserve. This is the endgame scenario. The forecasts we have, they range wildly for the short term. Some analysts see us dipping to a final low of 61,000. Others see a sharp bounce back to 137,000 by year end. But when you look out to 2035, the numbers start getting serious. $250,000, $350,000 per coin in today's dollars.
What drives that kind of move? Is it just more cycles of inflation?
Inflation definitely plays a part, but the real catalyst, the phase shift they talk about, is the concept of a nation-state strategic reserve.
Meaning a government, a central bank actually buying Bitcoin for its treasury?
Yes, a nation-state officially adopting Bitcoin, not just as, legal tender like El Salvador did, but as a core reserve asset sitting right there on the balance sheet next to their gold bars and their U.S. Treasury bonds.
But for that to happen, governments have to stop seeing it as a threat and start seeing it as an opportunity.
And that is precisely why this current moment, the stress from the Warsh effect, the tariffs, the geopolitical tension, is so important. This is the stress test that leads to what the sources call regime recognition.
Regime recognition.
Right now, governments are testing the network. Can we kill it with regulation? Can we kill it with hostile monetary policy? When the answer keeps coming back, no, and the network just keeps producing blocks every 10 minutes no matter what they do, eventually the strategy has to shift.
It shifts from how do we fight it to how do we join it.
It's pure game theory. If you can't kill it, and your geopolitical rivals say a BRICS nation might be secretly accumulating it, then you are at a strategic disadvantage if you don't own any. It's sovereign FOMO.
So if a major G7 country announced even a 1% allocation of their reserves to Bitcoin, what does that do to the price?
It reprices the entire asset class overnight, instantly, because there are only 21 million Bitcoin ever. There isn't enough for every central bank on Earth to have a 1% allocation. If the USA or China or the EU announced they were buying in, the price wouldn't be $65,000. It would likely be in the millions per coin. The entire liquidity profile changes completely.
That is the hyper-Bitcoinization scenario that people talk about.
It is. But that's the wild upside case. We have to remain grounded. The survival case is simply that it continues to exist as a valuable niche asset worth maybe $200,000 or $300,000 that serves as a check on government monetary power. Even that is a massive victory for the world.
So it doesn't have to replace the dollar to succeed. It just has to offer a viable alternative exit door from the current system.
Exactly. It's an exit door. You don't ever have to walk through it, but knowing it's there keeps the people running the room a little more honest.
Which brings us to the final thought for today. And this one is a bit of a curveball from the sources. It references a German philosopher, Fichte, and poses a kind of ethical dilemma.
Yes, Johann Gottlieb Fichte. He wrote about the ethics of money and currency way back. And his argument, put simply, is that for a currency to be ethical, it must provide stability. It has to allow a regular person to plan their life.
Okay.
And if a currency fluctuates wildly, if you can become, and this is his quote, a pauper or really rich in a matter of a couple of days, is that an ethical system?
That hits home. I mean, there are people who bought at the top in 2025 who are feeling like paupers right now.
Exactly. And so the dilemma these sources leave us with is this. Is Bitcoin a tool for financial inclusion, something to help the unbanked, the people in Argentina or Turkey who really need a way out? Or is it just a tool for wealth building, for speculators in the developed world who just want to make more fiat dollars?
Because if you're just here to get rich quick, you are part of that volatility. You are part of the very problem that Fichte is describing.
Precisely. The question for you, the listener, is if you are buying today at $65,000, you have to ask yourself, are you a speculator who is just hoping to sell for more dollars next month? Or are you a sovereign individual who is securing a spot on an immutable ledger for the next 20 years?
That is the crucial distinction, isn't it? Your intent matters.
The survival of the project and the answer to that deep ethical question depends entirely on which one of those you are. Because the market, over the long run, will mercilessly flush out the former and handsomely reward the latter.
Wow. Okay. That's a heavy thought to end on. But I think it's exactly the right question to be asking in a moment like this. Are you here for the price, or are you here for the protocol?
That's the signal through all this noise.
On that note, we're going to wrap up this deep dive. Whether you're holding, selling, or maybe even buying the dip, we hope this gave you a better framework to understand the red candles.
Keep learning. That's the key.
We'll catch you on the next one.
I'm Satosha.
And I'm Satoshi.